Wow, we have a must-watch video for all Tesla stock investors because what in the world happened today? Big tech sold off, the average stock rallied, the Russell, well, did way better than the NASDAQ. Is this the great shift of capital that I've been talking about? And if so, why did Tesla not participate? See, today, a lot of money managers, hedge fund managers, started to get bearish because of one reason. And we'll go over that here in this video. Now, JP Morgan's private bank, this is a bank for big money, well, they actually had some very positive things to say about stocks heading into 2024. And conversely is exactly agreeing with what I've been saying over the past couple of weeks. That's exciting. But JP Morgan's head of technical strategy says the S&P could fall 20% from here. What in the world is going on? Here in this video, we're going to get into exactly that. Nick Timmerhouse is sharing with us another chart. Some data came out today that is very encouraging in regards to the inflationary outlook. We're also going to get into the data coming out tomorrow and how this could affect our markets. We are also going to take a look at the option activity for Tesla stock today. Another good sign that maybe a flip for Tesla is coming soon. We have a lot to get into in a very short amount of time, so let's go ahead and get into it. If you guys like what's in this video, if you think other people should hear this, which I know other people should, but if you think so, hit that like button and subscribe to the channel. That's the best way to push this video out to an even larger audience. Let's go ahead and get started. Tesla stock was down 1.36% in regular trading, down another 1/10% here in after hours. Your NASDAQ got beaten up, down about 1% today. Your Russell 2000 was up about 1% today. So complete opposites. Now, why is money going into interest rate sensitive companies? The companies that are supposed to do poorly during a recession, well, they're actually doing well today. It's because the bearish narrative that hedge funds and institutions are spreading today is actually a soft landing. And that's what is sending down your big tech names. See, the argument today from a lot of money managers is we're not going to get rate cuts starting in March, but maybe in June or July or further in 2024. That's implying a soft landing. I mean, if that's the case, you want to own stocks if we don't get a recession. Your worst case scenario for Tesla stock next year is a moderate or deep recession. Well, what money managers are saying today is far from that. Take a listen for yourselves.
So a retest of the lows for 3,500.
We're at 4,500.
Yes, 20% down from current levels.
Oh my God! And so that starts till we get finished with the Santa Claus rally. Does this last a little longer?
Maybe a little bit longer, but it's already starting to decelerate to the point where our algorithmic-based signaling is already starting to show that you should be lightening up positions and starting to hedge at this point already.
I'll say I'm running for the hills. We don't do anything. So 4,600. It's starting already, but in earnest begins at the beginning of next year.
So if you look at stall speed hitting as early as the second quarter and into the third quarter, the markets, if given their typical rates of lag, should start to price that, the
right
first
away.
quarter.
In January.
My base case view is 3,500 by mid-year, and then if the yield curve's steepening as we expect, the market makes its bottom and starts to price in the next cyclical advance.
Towards the end?
Let's call it mid-year, yeah.
That's down somewhere around
3,500 where it makes its low.
3,500 where no one's expecting that. That would play into the secular trading range.
That's right. Yeah, we've been in a 3,500 to 4,800 range. That's right.
Yeah, that we're going to make and then when do we finally go to new highs? I mean, that's too far out for you, probably.
No, I mean, like if the curve's going to steepen and the Fed's going to be allowed to start easing in the second half of the year, we think about 2025 could actually be a positive year where you actually move on to new highs.
We think that there may be certain factors that may be conducive to inflation decelerating this year that may stagnate or even reverse in 2024. So we may, in fact, hover above this 2% core PCE mark for quite some time in 2024. And that would, of course, induce the Fed, all else equal, to start cutting rates later rather than earlier in the year.
That Nicole just put forth, as did Rick, that I don't know that there's an immediacy in terms of the need to cut rates. I don't see why. I mean, Rick did say by the middle of the year they could be cutting, and I think that's a reasonable position, that the economy will have evolved and the path of inflation will have evolved to a degree such that they could probably begin actually, or at least contemplating, cutting rates by the middle of the year. But before that seems unnecessary to me. I'm not particularly concerned. The economy is doing just fine right now, and I don't know that there's any immediate need to reduce the level of interest rates.
But
Now, even though Tesla was not super green today, like a lot of your small and mid-cap stocks, I do expect at some point that will change. Tesla right now is being grouped into your mega cap tech names, not your interest rate sensitive names. That's because of, look at its market cap. But that will shift, likely heading into 2024, and Tesla will start to see a lot more inflows. At least that's how it looks to me. But there's no set day, no set week, or set month for that matter, that the flip will actually take place. But as long as we actually avoid a recession, no matter what the outlook looks like for rate cuts, that will happen. And money will continue to flow out of mega cap tech names, Apple, Microsoft, Google, Amazon, even Nvidia for that matter, and make its way into names like Tesla and some of your Russell 2000 stocks. We've seen it start already, what I am dubbing the great shift of capital. It's actually happening right now. It's been happening for the past 2 weeks or so. But JP Morgan's top chartist says the S&P 500 will tumble all the way back to 3,500, retesting the bear market lows. That is the first guy you listen to in the clips from CNBC. But wait a minute, because JP Morgan's investment bank said quite the opposite. JP Morgan's private bank released their 2024 global investment outlook today. They say inflation will likely settle and that you should still hedge against it. Compared to this same time last year, the inflationary outlook is far less bleak. However, we think that the 2% mandate will become the inflation floor, not the ceiling. Therefore, investors still need to prepare for a higher inflation world, just not as high as we've experienced recently. To grapple with the prospect of more meaningful inflation in 2024 and beyond, investors might first look to equities. Public companies may continue to maintain both pricing power and their margins. They say, moreover, while investors used bonds to help insulate portfolios from slower growth in the previous cycle, the 2024 outlook notes that investors should consider an allocation of real assets as an inflation hedge for the cycle ahead. JP Morgan's private bank goes on to say that holding too much cash is a problem, that you might want to deploy that into assets, which is obviously true. Equities offer the potential for meaningful gains in 2024, even as economic growth slows amid higher rates. Large cap equity earnings growth should accelerate and may propel stock markets higher over the next year. Quote, we believe the U.S. large cap corporate sector has gone through an earnings recession already, with 8 of the 11 major sectors in the S&P 500 having reported negative earnings growth for 2 or more consecutive quarters over the past 2 years. These companies have emerged leaner and resilient to potential challenges that 2024 could present. Check this out. Investors don't seem to have missed the valuation opportunity. While the S&P 500 trades at an above average valuation, there is a substantial discount to be found in US mid and small caps as well as European emerging market stocks. Additionally, the promise of artificial intelligence and the potential upside in the stocks of drug makers with a growing share of weight loss market share also provide an attractive opportunity for investing or for investors looking into next year. They also say pockets of credit stress loom, but they will likely be limited. They say next year could see stress in certain sectors of the credit complex. For an example, commercial real estate loans, leverage loans, and some areas of consumer credit like autos and credit card and high-yield corporate credit could be vulnerable. An inescapable fact of the business cycle is that higher interest rates make credit harder to come by. We think these stresses will be manageable and not enough to cause a recession in 2024. So here's a 15-second summary of what JP Morgan is telling their wealthier clients. Expect higher inflation. That means you probably want to own stocks, maybe not all stocks, but small and mid-cap quality names look attractive, and we're not going into a recession in 2024. That's precisely how I would summarize what JP Morgan is telling their richest clients. That is exactly what I have been saying this whole time for multiple weeks now. Small mid-cap stocks, that's where you want to be. Interest rate sensitive names. The only problem with that is if we go into a recession in 2024, in which 2024 is an election year, and the current administration will not stay in office if there is a recession. So I think you would get 10 rate cuts before you would see a recession. Rates would basically go to zero before we go into a technical government recession. And the government would risk hyperinflation before giving up the presidency to another president. So I think your odds of a recession are way, way lower than some people would like to imagine in 2024. But then again, I do think we've been in a rolling recession for the past 2 years now. So take that as you will. Okay, but I have to give it to the bears. I won't give them the whole pie. I'll give them a piece or a bite of one piece of pie here. The money managers that are going on CNBC have at least a slight point. If we get data coming tomorrow throughout the rest of this week that shows the economy is just so strong that the Fed doesn't have any pressure to cut rates, then they might not as quickly as the markets are pricing in. Over the past really 2 weeks or so, you've seen the markets say, hey, we're getting 5 or maybe 6 rate cuts in 2024 because inflation is just falling so quickly. And we got more data today that supports inflation continues to fall quicker than we think. That's good. But if we get any data to the contrary of that, well, we might no longer price in a rate cut in March. We might start to price in the first rate cut in May, maybe even June. That's where I could see some short-term problems for our markets. But my base case is still inflation falling faster than expected. The economy not running red hot, but really just chugging along. In that case, I'm not expecting this to flip. I'm not expecting rate cuts to get priced in second half of 2024, like some of these money market, money managers, I should say, are expecting, at least what you heard from today. There was a lot more, but I didn't want to make that clip too long. I'm not in that camp, but there is a high-ish probability that could happen. Maybe 30, 35, 40%. Probably a, 55, 60 plus % chance that things just keep going how they are and we actually do get the first rate cut in March. But that is a problem. If we're expecting 5 rate cuts today, a data report or 2 that says the Fed should not cut rates that much, well, the markets might start to price in 3 rate cuts or 4 rate cuts. And that could short term be negative for equities. So be on the lookout for that and the data coming out tomorrow. The data tomorrow will be ISM Services PMI. Now, this market is very tricky because you don't want to see the economy doing so good the Fed doesn't need to cut rates. But you also don't want to see the economy so bad that it looks like we're going into recession. So it's a very fine line or fine bracket, if you will, we want to stay in. Tomorrow, you're expecting the ISM Services PMI at 52. Last month was 51.8. So anything above 50 is probably okay. Anything like 49, 48, probably okay. But if you were to get like a 45 or a 40 reading, then you got to question whether or not we're heading into a recession. And then anything like 55 or higher, you have to say, wait, the Fed is not going to cut rates nearly as much as we expect in 2024. So let me rephrase that again. 45 and under, recession fears. 55 and higher, the economy is running too hot. So you want to stay in that bracket, preferably on the lower side. You are also going to get JOLT job openings coming out tomorrow. For September, we had 9.55 million job openings. For October, you're expecting 9.35 million job openings. So a contraction of about 200,000 job openings. Now, how do you get a contraction in job openings? Well, basically, this is like your Dollar General with a hiring, sign in the front window that's hiring for 3 jobs. Well, maybe people are slowing down. They're not spending as much money. They're not going to Dollar General as much. Now they're looking to hire 1 employee. Well, that's a reduction of 2 job openings. So if you get that happening at too fast of a pace, that's also bad news for the economy. Let's say, for an example, just theorize with me. This is not going to happen, but just theorize that we come in at 7 million job openings tomorrow or 8 million job openings. We lose over 1 million job openings. Well, that's not exactly a great sign for the economy. At the same time, if we have a lot more job openings, meaning companies are looking to hire more now than they were last month, that's showing the economy's running a little bit too hot. So again, this is one of those data reports. You want to be above 8 million, preferably around 8.5 million would be a sweet spot, I would imagine. But you don't want to be above 10 million. So you don't want any extremes with the data coming out tomorrow, or it will have implications for stocks as well. And those implications would be bad news. In regards to Tesla specifically, NIO reports earnings tomorrow morning. I've had quite a few people that have asked me, even in the trading community, what I think about NIO. If you look at NIO's chart, it's trading at like $7. It's the lowest it's been in a while. NIO doesn't have to give you really good earnings for the stock to do well. It's already in the toilets essentially. So that could actually be a positive catalyst for Tesla as long as the earnings are not too bad. You also have other earnings like Dollar General and Broadcom on Thursday, Ollie's, some other names that could be important, if you will, for the gauge of the consumer. Toll Brothers reports earnings tomorrow in after hours. I did make a trade on Toll Brothers. If you guys want to come join the trading community, get access to the theory on why I made that trade, well, check it out. Link down below in the description of this video. But Dave & Buster's could also be important. Restaurants, the health of the consumer can definitely be in focus there as well. Now, Nick Timmerhouse on X is sharing with us this chart. This was a couple hours ago he posted this. It says the New York Fed's measure of underlying inflation, the multivariate core trend rate, ticked down to 2.6% in October from 2.9% in September. This was the lowest reading since January of 2021, and here you can see it. Core PCE around 3.4%, headline PCE around 3%, and your multivariate core trend, your median, is at about 2.6%. So things are trending in the right direction. Today's report was another, reiteration of that, but it's not enough to get the markets to actually be excited about that. Or you would have seen stocks in the green today, broadly speaking. But again, you did see interest rate sensitive names do well, and that's a trend that I expect to continue. Tesla in the land of options today was also pretty bullish. You had 654 hedge fund institutional option trades totaling $1.83 billion with a positive order value of 61%. So that was more bullish than not. For any Tesla bulls out there, which is probably a vast majority of you guys watching this video, you want to see Tesla remain above your 50-day moving average at $234.64, and you want to see the stock break out above the 100-day moving average at $244.85 per share. A break above around 245 could send you to 260. A break above 260 is your ultimate level. That's going to send you close to about $300 per share, in my personal opinion. And that's still my base case towards the end of this year, if not the beginning of 2024. Again, at some point, the sentiment will shift to say, hey, we're buying these small and mid-cap stocks because they're interest rate sensitive. Well, isn't Tesla interest rate sensitive as well? Isn't Tesla high quality and growing aggressively and reinvesting in their business aggressively? Shouldn't we be buying Tesla as well? Eventually that will shift and you will start to see inflows to Tesla, probably see outflows from other big tech names at the same time. This could be negative for your broader indexes, for your triple Qs, your SPY. Don't be surprised if they fall. But don't be surprised if Tesla actually rises and your Russell continues to do well. Tesla's RSI is sitting at 51.49, so I mean, there's a lot of room for a rally there as far as relative strength is concerned. Your MACD is still pretty dang positive. Your MACD line is at 2.97 and your signal line is at 1.89. The fact that both of these are still positive, really not moving around all too much, is telling you something. It's telling you the stock's likely to break up from here than actually break downwards. If you do see the yellow line go under the blue line, that's a little bit of a problem, at least in the short term. Total EV sales in the US just surpassed 1 million for the first time ever, a major milestone. And this is only battery electric vehicles, not hybrids included. Hybrids included, you're already at 1.2 million, which is, still the highest number you've seen. Even last year, you were not at 1 million vehicles, including hybrid vehicles. But this is only even data from January through November. So it's really hard to make the argument that EV adoption is slowing down in the US. If anything, it might be actually picking up. By the end of this year, it'll be more definitive. The Biden administration has released long-awaited rules designed to block EV manufacturers from sourcing battery materials from China and other foreign adversaries. Ford says its Mach-E will no longer be eligible for any federal tax credits starting January 1st, 2024. But Ford does say their F-150 Lightning plug-in pickup truck built in Michigan will continue to qualify for the full $7,500 credit, the company said in an emailed statement. Oscar Herrera says, isn't the administration thinking about changing this? Sawyer Merritt says, potentially, but nothing is finalized. This is something I've talked about a couple times here on this channel. This could be some big news towards the end of this month. The administration is looking on basically phasing in these rules for the tax credit, basically to allow for the $7,500 tax credit in the current form that it is. So like a Model 3, a Model Y, right? Tesla vehicles might be able to qualify for the full credit in 2024 as well. Ford sold 8,958 EVs in the US in November. The Mach-E is up 21%. The Ford F-150 Lightning is up 113%. The E-Transit is down 59%. In total, you've seen 8,958 deliveries, up 43% with a 6.4% market share. Let me know what you think about all of this information down below in the comment section. Hit the like button and subscribe to the channel if you made it to the end of this video. Consider joining the trading community if you guys would like to get access to all of the notifications I send every time I make a trade or whether or not there is big news on any given day. We do try to keep you guys as informed as possible. You can come ask questions, come learn, no matter what your experience is, whether you are a beginner, you've traded options before, you've done different strategies. Well, if you're experienced, if you're a beginner, it doesn't matter. We'll welcome you with open arms. Thank you for watching. Enjoy the rest of your day. My name is Michael Tyler, and I will see you in the next one.